my great pleasure to introduce Sharon Van Valen. I have known her for many years. She's wonderful, always stylishly dressed, and I think she's going to give us a great presentation today. She, her focus has been, and her fame is for her many composition students who have won awards nationally and internationally. But today she's going to talk about something really personally important to all of us. Thank you,
It's all
Sharon.
about money today.
Yes.
I need a music. Thank you. I need a music stand up here if I can have one, because I've got little papers and it's hard for me to keep them organized. So if I can get a music stand up here. Would you rather have me up here or down here?
I was giving you one.
Okay.
Anyway.
I'm going to go down and just see if there's a quick battery.
Well, actually, I probably am on the Zoom easier down here, right?
Yeah.
Okay. All right. And since everybody is freaked out about Bitcoin, before I really give you my presentation, I'm just going to read you a short article about Bitcoin. All right. And then I've got a lot of stuff on it that you can look at on my table. Okay, downsides of cryptocurrency include extreme volatility, and unlike many other investments, it's backed by neither assets nor cash flow. As such, it's important that cryptocurrency be added to a portfolio that's already diversified. If you're investing in cryptocurrency, keep the allocation to a small part of your portfolio because it is very risky, says James Royce, principal reporter on investing and wealth management at Bankrate. If cryptocurrency is the next big thing, you won't need a lot to enjoy attractive returns. And if it isn't, then your overall portfolio isn't hurt too much. Cryptocurrency's volatility looks set to continue, Burrell says. Okay, that's the gist of it. This is an article, and if you want to look a little bit further, cryptocurrencies work and how they don't. It's like, your computer's great until it isn't. It's sort of like that. All right. So I've got a lot of things just while I'm over here. One is, this is a big advertisement because miners for cryptocurrency use more power than the whole state of Washington, one miner. So they're terrible power consumers. And this is an article about some, so if you want some cryptocurrency articles to look at, I like this one with them being sucked into the tunnel with the feet hanging out. These you can just, a lot of stuff here you can take a picture of if you're interested in. I've got some cards. I have 2 newsletters that you can look at that I have taken for years. One is a communique by Oxford Club, and the other one is an income letter. And am I hard to hear?
I just heard that the microphone died, so I got.
Can you hear me all or not?
It's easier with the microphone.
If you want the microphone on? Okay.
So.
Is this better?
That's better for the people.
Okay. Anyway, you can take a picture of anything I have here. I have 2 other newsletters that I do take. One is a contrarian. This is recent because my recent investing, given what the market is doing, has changed somewhat. And then there's a picture of what to do for mom. Well, of course, I'm 82. I'm the age of most of your moms or older. And I'm going to tell you a story a little bit about annuities because they're very controversial. But they're not volatile and risky if you get the right one for you, like cryptocurrency. Okay? The first story I'm just going to tell you about that is I started, this kind of comes in the middle, but I started once you have a Roth IRA, once you have a 401k or whatever you're using, and I then got a simple and a SEP. I got everything I could get to minimize taxes. And then the only thing left was an annuity. So I decided to get one of those too. And I did this when I was in my 40s. I got the first one at Vanguard because it was free and it doesn't have any, I mean, it's not free, I mean, you don't have any penalties with it. So I just got that one first and thought I'd try it out. And then after that, various companies kept asking me if I wouldn't like to change and have a better annuity. And they would pay me $3,000 to change. So there's $3,000 of free money. And if they had a good product, I said, sure. And I did this about 4 times. One gave me $4,000, one gave me $3,000. I think a couple of them gave me $3,000, and one gave me $4,000 to change. So I thought, well, you know, there's $10,000 that it's free money. It was free money. And the annuities were better. So just the end of the story is, I had to annuitize it when I turned 80. In annuitizing it, this I bought for a death benefit. I paid high fees that they say, oh, don't buy these, they have high fees. This one had high fees. I wanted this on purpose as my inheritance to my 2 children and my niece. So I had to annuitize it when I was 80. I originally put $50,000 in it, and every time I moved it, it grew. And I have just given a setup for my children and grandchildren to inherit $600,000. They get $900 a month for at least 15 years. So that's what can happen. This, you can't buy an annuity like this anymore, I'm sorry to say, because it had a step-up basis monthly, which means if the market went up and they stepped it up for you, it could never go down from there. That is not true anymore. You can't go get those. They tried to buy it off me about 10 times because it was so good that it was too good to be true. And it was one of the things that truly was too good to be true. But anyway, so I told my kids, they blow it, that's their problem from now on. Okay. But anyway, so these are 2 newsletters I've taken for a long time and liked. These are the new ones that you could just take a picture of. I've just written off the portfolio. These are all online. This is a contrarian income, and that's a hidden yields. It's stocks with big dividends that are conservative and part of your basic portfolio, regardless of your play money, okay? And these are just some things on strategic annuities. These are cards. I've had an annuity in here for some time, leverage planners. And this is the article on what to get for your mother. You have to make sure you get an inflation indexed annuity if you should need such a vehicle. Because inflation, as you know, we're really seeing it today. We know what happens. And this shows you what an annuity can do versus the stock market and how one grows. So these you can just take a picture of anything. I'm going to speak a little bit about closed-end funds. That's what I've been doing recently. These are 2 I own. All right. You were supposed to have a handout. Does everybody have your handout?
Yes.
Good. All right. So how many of you are experienced investors at this point? Anybody? Okay. Yeah, some of you are. So I'm going to just go through, I think, what's most important on a basic frame. And if you have any burning questions right then, ask them. And if they're not burning at that moment, we'll save them. Okay? Okay, so the first thing, very first, I was going to tell you how I got into this, by the way. I've been in music since I was 3.5 years old. So that's my love. And, but I had a really bad divorce. And I took one look, my husband put me $25,000 in debt. And a few weeks later, I was going into severe brain surgery. And I was either going to be dead, blind, or mute. So this was not a very happy situation for me. And, but I decided that as much as I love music, I wasn't sure I could ever retire doing it. And not knowing what life held going forward, I said I better learn to do something else. So I had a real estate license, and I decided that wasn't what I wanted to do. But I had a broker This was just the time when the first Roth came out. I had a tiny little bit of money in a Roth because they had just come out to availability. So I also had a broker and I had a couple things with him. He made a big mistake on my portfolio. I recommended a closed-end fund to him. He put all of his clients in it. Then he made a big mistake on my portfolio. And at that point I said, I can do it better than he can. And that's when I started on my own. So music teachers are good at it because your left brain and your right brain are so connected. It's just like music. You have to do your scut work. You gotta do the counting, you gotta learn your notes, you gotta take a look at your dynamics, and then it switches, I always say it switches 20-80. At first it's 80% scut work, 20% heart. And then as you move through it becomes 80% heart, 20% scut work. And that's of course where we all strive to be. But anyway, so that's how I got into it, was through a mistake somebody made. And I found that I liked it, it was fun, and it's keeps your mind alive. It's a very interesting learning experience. So now I make money, a lot of money on options. I have options on a lot of stuff that's way below what it is, but I'm getting paid $600 for a big option on NVIDIA. And if it gets down to $100, I'll buy it. But I've made money on the option. That's a later time. But so the first thing to get into is your Roth IRA. Absolutely. And you know, for people over 50, you can put, I think it's still $7,000 this year into it. Other people can put $6,000 in it. That means when you go to draw it out, it's tax-free. And if you think of me where I am now at 82, I'm not retired, but if I were retired and I were having to draw something out, do I want to draw something out where I'm paying taxes and the market is so bad? No. I would probably rather just draw out what's tax-free and use it first. And then when I have, because as you get older, you spend less. Do I need more clothes? I've had this outfit for probably 25 years. You know, do you need more stuff? No, in fact, you're getting rid of stuff. So then you don't need the same kind of income. So that, I think, is the number one thing to do. And speaking with Mariah, she has put her kids in it, and this is what I thought was so good. And I'm going to pass this on to you. You can talk to Mariah more about it. But she put her kids in, and she gives them a salary. They do work. She pays them. They can put it in. They can start a Roth right now, as long as they don't, you know, earn too much. This year, because I paid so much more in taxes than Trump did, I couldn't contribute to my IRA. I'm sorry to say. I contributed to it and had to take it back out. I think I'll send him a bill. Okay. Anyway, so the next thing is for teachers. It used to be we had to start with an individual IRA, and that came after taxes. You pay your taxes on your money before it goes into a Roth. So you've already paid your taxes. I mean, the government isn't going to cheat it. They're not about to do that. But the other thing that you can do, and that I have, and I've looked at SEP IRAs, simple IRAs, I've looked at all kinds of 401k things that you can do. For me, the best thing to do was to go in for the simple IRA, because I can contribute up to, I think last year I contributed maybe $19,000 to my simple, and it comes right off your taxes. So it's a really good way to lower your taxes, is to also be contributing to a simple, if you can. And you contribute. It depends on how you make. How much you can contribute depends upon how much you make in general. And of course, part of my money is from stock stuff, not music stuff. So I just want to point out the simple IRA. It's another way to really lower your taxes. Okay, then I get into just annuities briefly if you're following on your sheet. There are many, many different kinds of annuities, and many of them have a bad reputation. And they deserve a bad reputation. They're extremely, you really have to understand one before you buy it. I'll tell you about one I have now. The one I got before you can't buy. But if they grow tax-free. When I was looking for another tax vehicle, this was my only choice. And then I found it worked really well for what I wanted. I wanted a very specific kind. There are kinds now that are totally different from I had. You have indexed annuities. I've got a little whole sheet on annuities. You have fixed annuities. Most of those you don't want. And the other thing that you want that they will promote is a capped annuity where it prevents anything you put in from going down, but you can stay at zero. In other words, this year, I bought a small annuity because my husband, we had an issue with our house, had to be totally redone. When we got married, we did a post-nuptial agreement, which you can do in the state of Washington. I kept my stock portfolio. This was a third marriage for me. And he bought the house. So the house was his totally. And it had to totally be rebuilt because the person who built it hired workers who could not read English, and they put all the substructure in backwards, and it all rotted out. So we have a 3-story townhouse that had to be torn down and rebuilt, to the tune of $350,000 for the building and $50,000 for the grounds. So he put a line of credit on the house, and then that wiped out so much of what he had. He'd been retired for some time. Therefore, when the stock market crashed, it virtually wiped him out. And then they decided to call the line of credit. So guess who got to pay the line of credit off? Me. I paid the mortgage off for the house, and I paid the line of credit off, which was $400,000. I did it in a year and a half, 2 years. 2 years. And in doing that, I bought an annuity that is not the kind I would usually recommend for people. I bought a small annuity because I still owed some. And at 82, you don't know whether, my mother got hit in a crosswalk by a truck. You know, you don't know what's going to happen. So I thought, okay, there's this much left. I'm going to make sure it can get paid off because my husband is no longer in good shape. He has dementia. And in the process, it doesn't have a cap, but it can grow. It has a penalty of 10 years. So before I want to draw, I can take 10% out of it anytime I want, but I don't need to, so I wouldn't. If I don't take that out, it's worth $30,000 more when I do cash it out than it is. It's grown. At this point, I put $70,000 in it because that's what I have left on the bill, and it's now worth $90,000, and it can't go lower. And this year, what's it going to do? The market's dropping like a rock. So it will stay at zero. In terms of it'll stay at 87 to 90,000. It'll stay at 90,000. It can't drop. That's the good news about an annuity. And it can give you finally a stream of income later in life. They have annuities that have no deadline. I had to annuitize mine, which means it would not grow anymore. I had to begin to make a plan to draw it out. And I knew that was going to happen. So I was prepared for that. But they have so many different kinds that if you decide to take a look at some of these, what you don't want is one that gets capped. Like they have where the most it can go up is 5%. Well, half my stuff went up 40% last year. Do you think I want something capped at 5? No, you have to be so careful about really looking at what they offer. And you have to ask them for multiple things. Each company will offer things that are very different. You don't just go to one company and check theirs out. If you're interested, you go to multiple companies. And so mine can grow unlimited, and I have certain choices as to what I can put in, and I can put a combination of bonds, I can put stocks, I can put growth stocks. I can't manage them, but I do have flexibility in each year. If I want to change my allocation, you don't, it's limited changes, but you can change your allocation. So, I still think if you have enough money in your Roth and any leftover that you want to make more tax-free, an annuity is a really good thing to have. And it's good to build because it does then provide you with a stream of income at a later date. And if it's inflation indexed, then it's wherever you are, it's going to be better than if it isn't inflation indexed. So, I'm not looking at what I wrote down here. Any questions? Oh, the other thing that's terribly important, almost like timeshares, you've got to know how you exit one. How do you exit? What do they require on the exit? What are your advantages? What if you die first? Will it go to your heirs, or does the insurance company just take? These are insurance products. So you must know how you exit. I knew with mine, my big one, how I was going to exit. I wanted it as the benefit for my kids and my niece. And that was the whole plan when I set it up. Now, the one I have now, I paid the debt off. I don't really know how I want it. I don't really care too much. It's not going to be worth enough to care very much. So whatever happens, I'll figure it out later. Anyway. But you can withdraw 10% without a penalty. Most annuities have a penalty phase. You have to leave it in for a given number of years. And during that time, you can take this 10% out. But to get the real maximum benefits of it, they do have a penalty phase, most of them. And if they don't, you want to look at them really carefully and see exactly what they do. Okay. All right. Does anybody own other properties here? Okay, some people do. People who are good at that, that's a wonderful avenue. My husband, first husband and I were miserable. We bought a rental property. Some people got in, trashed the house, and then you can't get them out for 6 months. And it was a nightmare. Plus, it was terribly expensive. I mean, we lost a lot of money on that. So if you're really good at it and you know that business, it's a great business. I buy real estate investment trusts, which have to pay out 90% of their earnings to the stockholders. They have to, so I buy REITs. And I have CNS, which is Cohen & Steers. That's been a great REIT for me. It's a stock that sells on the stock exchange. Okay? So I don't deal very much with rental properties. I'm just telling you if some of the best ones that you want to look at are, like Amazon has all these data facilities. And I can tell you the company you buy, I've got to put in on it. It's STAG, S-T-A-G. That's the real estate company that does a whole lot of Amazon's buildings. And it's not very expensive. I've got to put on it for something like $30, $35 a share. Okay. At this point, I'm going to just tell you about stocks versus funds. I quit buying mutual funds for the most part because I got tired of paying taxes on shadow income. How many know what shadow income is? Nobody? Okay. Well, shadow income, you find out really fast in a down year what shadow income is. Okay. I buy a mutual fund. All right. It goes up. I'm very happy. We hit a time like now and it goes way down. And in that process, when it goes way down, it has, say, 30 or 40 stocks in this vehicle. They sell stocks within it. Some maybe they sell for profit, some they sell for loss. Any profit that they make, you have to pay taxes on even though you only own the fund. So your ability to sell that fund, say, has gone from 50 down to 30, but you're paying taxes on all the things they sold during the year that they made money on. Because sometimes, you know, they give you a yearly end dividend, and you will pay taxes on those dividends, but you can end up making nothing and having it go way down, and you pay taxes on it. So I pay taxes. I have a lot of dividend stocks. I pay taxes if they pay me dividends those years. Those pile up, and I pay tax on it, but the tax is lower than your income tax. It's a different tax, and so far it's still lower. They're trying to raise it for very wealthy people. I'm not too worried about that, okay? So I avoid mutual funds with the exception of ones where I don't understand the market well. I have one mutual fund that I think is very good in the world of healthcare, and it includes biotech. And I have a really good one. I have Oakmark Select, which does foreign and domestic, and I don't understand. I have some foreign stocks. I have a Japanese bank. I have also SoftBank in Japan. But basically, I don't know the world of foreign stocks around the world well enough to feel I want to stock pick on that frame. It's too much. So I will buy a fund if I like it. And Oakmark, I think, has been very good. And the other one I like is T. Rowe Price International Discovery. I think that's a fantastic international fund. It's been very, very good. It's still way up. Okay.
Is a mutual fund the same as an index fund?
I can't hear you.
Sorry, is a mutual fund the same as an index fund?
No. A mutual fund is not the same thing as an index fund. A mutual fund, it can be a diversified fund, or you have lots of mutual funds like I just described too. I have a health biotech fund, and it buys health related and biotech fund of biotech stocks. Now I also have a lot of biotech and health individual stocks. I have ABBV, AbbVie, not Abbott Labs, but it's the two split apart, and I have the ABBV part of it. I have Bristol Myers Squibb. I own Pfizer. So I own a lot of individual stocks and have for a long time. Medtronic, which deals in devices and heart issue things. So I do have a lot of individual stocks. But I bought that one quite a long time ago, and I've just never sold it, and it's been very good. But if it goes way down, I'm going to pay money on my shadow income.
The mutual fund that you mentioned, something, what was that?
Which one?
You mentioned a mutual fund that you do have.
Oh, I have several.
Something.
Oakmark. I have Oakmark Select is one of my favorites.
Oakmark?
Oakmark. It's a company that deals in mutual funds. T. Rowe Price is a well-known company that deals in mutual funds. I have their health biotech, and I have their international discovery, which I've had for a long time because they deal, again, it's a real diversification for anything I do because they own stuff that I have. Nothing like it. So I've been recently, does that make a difference? ETFs. Well, often the ETF market is one where I have been buying closed-end funds. They often have the same things that the ETF market has, except you get paid 7 to 11% to own them. So I would buy closed-end funds as opposed to an ETF. I don't like ETFs. They've gotten too wild, too big. Some of them are good, some of them are not. I think it was a good idea when they started because their fees are so much less. But I don't like, I mean, it's another kind of mutual fund. The difference in an ETF and a mutual fund is you can only buy and sell a mutual fund at the end of the day. ETFs you can buy all the way through the day just like a stock. Okay? You can do that with closed-end funds also, which I am going to get into. All right, bonds. Do any of you have bonds? Okay, I'm not too big on bonds. I never have been except individual bonds. I have a Morgan Stanley individual bond that I bought a long time ago. Most of them will have a set date when they cash out. This one does not. It's an unusual one. It has an ongoing, and it pays me 5.7%. You can't get 5.7% very, even with the bonds going up, you can't get that. And I have another one that got called. And I think at this point, I only have two bonds. One is a Ford bond, and one is this JP Morgan bond. The JP Morgan bond has come down in price and might be worth looking at. Might be worth looking at. Anyway, so for a lot of people, they feel safe with that. Oh, I just said it's guaranteed to pay me back. Oh, if you hold a bond to maturity, this is the other thing, don't buy bond funds. You never have a guarantee on a bond fund. Bond funds are the worst things to buy. In my whole life, I've never bought a bond fund. I buy individual bonds. In the 80s, when we hit high inflation, they're comparing today to the 80s. Well, I lived through the 80s. And bonds went way up. I bought a bunch of individual bonds because my children were getting to the ages they were going to be pushing for college. And the bonds were paying, I bought one bond that paid me 18%. I bought one that paid 12%, individual bonds. And they have to pay you a certain amount to own them. Going in, they usually pay you a certain amount of money twice a year. And then you get your money back. Either you get more, or you at least get your money back at the end of the time that the bond exists. So you never lose money, with the exception that if you have high inflation and you could have invested it at some place where it stayed with inflation, you would have been ahead. But you don't lose the actual money that you put into a bond if you buy it and hold it to maturity. So you can watch it go down. I have my JP Morgan down and they're usually like $5,000. If you buy 5 shares, you have $5,000. They're usually $1,000 a month. Okay, so I put 5,000 in the JP Morgan, and I think it's right now down to about 48 something. Do I care? No, because I like how much it pays me. And secondly, I know that I'm going to get my 5,000 back. I just hang on to it. Those are things you just kind of hang on to when you get a good one. You would only sell one of those in desperation. Okay, and then, again, they do add some stability to a portfolio. So, at least I own all of 2. I have a very big portfolio. And now, municipal bonds, if you are older, if you are over, if you are retirement age, or I'm not sure when the age kicks in on munis, but say they pay you 3%, but they gave you more money, so it is the equivalent of taxable, say 5%. If you have 2 kinds, look at your bond sheet: municipal bonds, general obligation bonds. They do schools and roads, and you get those sometimes through your school district. You'll get bonds that get offered on when you're voting for things. Okay. Revenue bonds. These are for the big projects, the airports, our transit system, things like that. These are funded by the project. In other words, it used to be we had to pay, a tax going across the 520 bridge. Well, all that goes in to pay for that. And then all that goes in to pay for the revenue bonds, which are part of municipal bonds. Okay. And they are worth looking at, but again, you have to look and see what's available and how much it's paying and what that means in terms of taxable income. Okay? I put here, they're often a good source of income for retired people because they're tax efficient. Okay. Preferred stocks. Does anybody know what a preferred stock is? Okay. I think preferred stocks are great. I gotta watch my time here. I have till 11.
Yes.
Okay. All right. Preferred stocks are very good when the market is tentative. A preferred stock is basically between a stock and a bond. In the hierarchy of getting paid back, if you own bonds in a company, say I own a bond in Ford. Well, Ford goes bankrupt, I'm gonna get my bonds paid first. I also own some stock in it. If I had a preferred bond, a preferred stock, I would get that paid second. The last thing they pay if they go bankrupt is me as the stockholder. If they go bankrupt, I might not get paid anything. But they have to pay the bonds back first. So there is a hierarchy of what happens with down markets. How many people remember when Washington Mutual went under? Most of you, well, quite a few, okay, I lost $55,000 in Washington Mutual when it went bankrupt. That's my biggest loss I've ever had. And 1 week before they went bankrupt, I went to their annual meeting. They were doing a certain kind of mortgage called asset-backed mortgages, except what they did was bundle. That was when real estate was selling for nothing down. How many of you remember that? I looked at homes in Arizona that people were big homes, expensive homes. People were buying with nothing down, and I said, you know, I'll bet in about 5 years there's real hell to pay for this. And it was. I think it may have taken a little longer than 5 years. But at any rate, they bundled these mortgages that they knew people virtually couldn't pay. People got into these houses with nothing down. They didn't have the money. They couldn't support the house. And of course, they lost the house. And so then eventually the housing market crashed, as you all know. But they bundled good mortgages that people were given when they paid 20% down, and then you are beholden to your mortgage. You have to pay that off every month. They bundled more of these ones where they knew people couldn't play with them. But they told the stockholders that they didn't do that. They didn't have any of those. They didn't have those kind of mortgage-backed bonds because we'd been warned against them. And they had a whole lot of them. I had a friend who's a very well skilled businessman, who's one of the company. He bought Washington Mutual all the way down. I just watched it go down. I didn't sell it. I had a huge profit in it and watched it go down to zero. And then that's one lesson. You only have to learn once in your life. You learn not to do that anymore. You learn to sell it. Even if you sell for a loss, you learn to sell parts of it if you have it. But, so the market is tricky. It's humbling. You know, you can never think you've got it figured out because you don't. I don't. You know, I'm losing money right now, kind of hand over fist. But I have enough that I put in there. One of my students asked me the other day, he says, how are you faring with it? And I said, well, my ExxonMobil pays me, because I have a lot of it, it pays me $600 quarterly as a dividend. And if it's been, now it's up, but say I have a stock that was cut 50%. And I have enough of it now that's paying me $600 a month in dividends. Well, so it buys me twice the amount of stock and I don't even see it. I just have dividend reinvestment. So that when those dividends come in, they just automatically buy me more stock because I don't need the money from the dividends at this point in time. So I said that it's going to buy me twice the amount of stock. To me, that's a good thing because I know it's a good stock and it's going to go back up again. I've lived through a lot of these. So I know that selling usually is not the smart thing to do if you have good stocks. Now, if you have stocks that are questionable, faddish, whatever, then I would get rid of. I have a lot of splits. I've had a lot of little things. I have a little bit of this, a little bit of that I probably need to sell. I usually kind of try to wait and see what it does, but
How do you know if it's a good one or a bad one?
pardon?
How do you know if it's a good stock?
You research it.
Oh.
Okay, I have a little thing here that you should all take a picture of. A lot of these you should. Is the company currently making money? Good question. Has it made a profit in at least 7 of the last 8 years? Does it have plenty of cash on hand? Oh, sorry. Does it have plenty of cash on hand? Does it have the right level of debt for its size? Real estate, REITs, you really have to check on their debt level. You don't want a REIT that is way over its head on debt, okay? Is its industry growing? Have the shareholders gotten a good return on their money? Has the company created any new products or services recently that might increase the value of its stock? Has it recently revised its earnings estimates upward? Okay. One big company just did that today. Which one was it? Oh, I can't remember. Are some investors selling the stock for reasons that have nothing to do with inherent quality of the company? All right. And is the stock's price rising but still reasonably priced? And that you want to know what a PE is. Is there anybody who knows what a PE is? PE is price to earnings. And Zoom at one point was like 100 and something price to earnings. Okay, that means you have to have a price to earnings at 100. Okay, what would be right is if your price and your earnings matched, or your price was low to earnings. You get 110 price to earnings. I'm not going to buy that stock unless, okay, a lot of people bought Amazon, bought Google. Some of those companies went way up and they just figured they were going to go to higher price to earnings, and some of them did. I do not own Amazon, except I own it through one of my closed-end funds. Actually, I own it through several closed-end funds I have. But I own Microsoft, and I own Apple, and I own Oracle. And I'm thinking, well, Google's going to split 5 to 1, Amazon's going to split 5 to 1. And now that it's come down, if it splits 5 to 1, that starts to look a little better. And I'm just debating whether I buy it before the split. Normally what happens, I bought Microsoft when it was $6 in the 90s, okay? It split. So then every time it splits 2 to 1, 3 to 1, 1 to 1. Okay, first time it split, it doubled my money. In other words, I have twice as many shares. Now, it doesn't double your money. The price of it goes down to what it is. But then people buy more of it because it's cheaper. And so then it tends to go up. So my thing, if I buy some Google or some Amazon, I'm waiting to see how low it goes. And then I might buy just a few shares, because I know it's going to split 5 to 1. But, and I did that with Apple. And then it split, was it 4 to 1? I can't remember anyway. I had 100 shares of Apple, and I now have 400 and some. Okay? So, that's the beauty also of owning stocks. You don't have to pay any tax on it until you sell it, unless it's a dividend-paying stock, and then you have to pay tax on your yearly dividends. But otherwise, you don't have to pay anything for it. You know, it's not like in a mutual fund where they sell it and they make the profit, but you pay the tax on it, and you don't get any of the benefit. So it isn't like that. So I pay taxes on the dividends I get. And early on, everything went into my individual portfolio, which today is hard on me because that is my biggest portfolio. I went from being $25,000 in debt after my divorce to over $1 million in not too much time in my portfolio. And it was mainly because I'm going to tell you how I started now, if many of you have not started. I bought one stock that I thought was really good. It was IBM. And when IBM, and it paid a dividend. And when I had made 25%, I'm trying to think what I did. When I had made double what I paid for it, I sold the part that was extra and then kept the rest as free money and then bought another stock. So that's how I started, like one stock, then two. I bought Procter and Gamble, you know, toilet paper, baby products, you know, the things that are never going out of style. And I still own Procter and Gamble, and it pays me a very nice dividend. And then again, when I would make thus and such much profit, then I would sell that which was over and above my cost and buy another one. So that's how I started becoming a stockholder. And I looked at a number of newsletters. If you buy one, you'll get inundated with 20 million. I'll warn you about that. But I like the Oxford Club. They have what they call a trading portfolio. I use it a lot for options. At this point in time, I do options. I made 122% on my biggest account last year, but I made also an extra 80% on my options. And once you get going with things, then I say, why should I pay? Amazon this morning was selling for, I think, 2,107, something like that. It went way down at one point. And so would I go in and offer to buy Amazon at that price? No, because some people say it's going down for it, but I might write an option on it. Either I'd write an option, or I might offer to buy it at something under 2,000. I have an option on NVIDIA that I said is paying me a lot of money for 100. They bought the option, and I think the option immediately, what I made on that, I believe it paid me $552. Question?
Can you explain what an option is?
Okay, options, to me just goes along. Once you understand how to buy stocks, research them, and you know you've got good companies, then there are two options that you can do. All right, I sell a covered call, and sometimes those get called, and sometimes you have to buy them back. In other words, first I had some money with the broker, and I took it back because he made mistakes on it. But he put me in Apple initially, and then wrote a covered call that was too low. So when I took over my portfolio, I decided I wanted to keep the Apple. So I had to pay like $1,200 to buy an option back that he put on. But in the long run, that was still really better than selling them, than letting them take the stock away. Otherwise, they could have called my stock away. He made money on the option, like maybe $100, and I have to buy it back for, say, $1,200. But in the long run, I'm better off to do that. Now, that happens once in a while. But right now, I mean, last year I made 80% because I usually put them so high, and you begin to learn the times of the year. Slow times of year. September is really slow. Sometimes the end of August. So I'll put an option that's way high, knowing that probably nothing is going to happen in that month. I mean, again, the law of averages says it's likely not to get called. So say I make $100 on a covered call. And a covered call is a safe option. This isn't a risky option. Because if it doesn't make that, and you put it high enough, it doesn't make that, either you don't sell the options, so it doesn't sell and you don't make anything, or it sells, but it never gets to that price, then I've just made $100 on that stock. And then I can write another one. It has a time period, so I put my due date at September. And it doesn't go up much in September. So it expires worthless. And when it expires worthless, I've already made $100 because they pay that initially when they buy it. Anybody who buys that call pays you right then and there. So I've already made my $100. And if it went up to the price I put, then they can call it away. They will call it away. But if they put it up to that price and I've got my price way up, say I've got it up 15, 20% from what it was worth before, occasionally, do I mind that? No. I just made, 15 to 20% of my stock. I sold some Microsoft that way before the end of the year. I had a covered call on it. I had several covered calls. 2 of them were in what we call in the money. They were at was it 335? 335 or 235? 335. And I just let one get called. I said 335. It's like the Bitcoin. Do I think this is going way up from here? Not in the immediate future, I don't. So I sold one of my covered calls at 335 and one at 330. And I still have a lot of Microsoft. So I've just written more. I've sold options as high as 410 for Microsoft. You can't do that right now because the market's low, but I have sold them. And a put. A put is you have to have money to cover. It's a little trickier. But I put I did a put in on NVIDIA for 100. And I think it's due in August or September. It's in those months when they don't do very much. Okay. Or it might be June. June it can go down. I don't remember. But anyway, if it goes down to 100 and gets called, then I have to buy the put, and it's worth 100. Every $100 would turn into 1,000. So 10,000. So I would have to buy NVIDIA for $10,000. I have to have the money to buy NVIDIA. I have to have $10,000 in cash that I can buy with if it gets called. Am I happy to buy it at $100? You bet I am. I have one on Zillow for 30. Am I happy to buy Zillow at 30? Yeah. If it goes down that low, I'll buy it at 30. That means I'd have to pay $3,000. Okay? But why do I want to pay $171 for NVIDIA right now if I can sell a call for 100? Why do I want to pay 42 for Zillow? I think Zillow is down in the 30s. Why do I want to pay 35 for Zillow if I can get it at 30 and get paid for the chance I'm taking? So I almost never buy any. You can't buy calls and puts on everything. Closed-end funds, some you can, some you can't. But I've just gotten so that if I buy something, I try to buy it lower. But it means you have to deal in 100 share lots, and you have to have the money to cover it. But once you have a portfolio that you've developed, then, it was a long time before I got into puts and calls, okay? First you have to have something built up that you're pretty secure with, all right? So I think I dealt with mutual funds a little bit. They have all different kinds. You can read that in my sheet. And I dealt with the exchange-traded funds. If you've read any of that and you have questions on that, I'm going to kind of skip ahead to the closed-end funds, because that's what I've been doing recently. And after all, what we are is about recent. I looked at, and then these I want to put, now I can put them in tax deferred vehicles. I have I have a regular IRA, a SEP IRA. I have another regular IRA that I actually have somebody else managing. It's not worth very much, but I just left it where it was. And a Roth IRA. Okay, so I have 4 vehicles that I can put taxable things in. And that's where I'm trying to put a lot of my closed-end funds. I had the first time I bought a closed-end fund was the first time I ever started investing. I've had that since 1984. That was the one I did with my broker, and he put all his clients in it and made a big mistake. It's SOR, it's called Source Capital. And out of that, I can tell you exactly what I paid for it. I think I have that down in here if you look at page 3. Source Capital, I've had this since the 80s. I've taken out 15K. I took that out to buy my daughter stuff when she got her first house. She needed a fence. I took 4K out and 10K out when she needed a car. She got back from Australia and didn't have a car. Anyway, it was a long story. And then I paid for, her husband got severe cancer, and they needed a finished basement, so I hired my son, who's a really good contractor. He's also a musician. He has a music degree, but he's a good contractor, to go and totally build her basement. So all that has come out of source capital. I believe I said somewhere $8,000 in it, and it grew. It's now worth, it was worth just before this crash, $103,000. Now, and so in taking all that money out, it still grows, and it pays me dividends quarterly of over $1,000 a month. So it changed hands. I'm not sure I like what it's doing now as much as I liked what it was doing before it changed hands. But, and it's worth, I can tell you how much it's gone down. I think yesterday it was worth $97,000 instead of 103. So that one stock item has gone down that much. But is it way over what I paid for it? Yeah. Am I terribly upset about it? No. Because it will go back up at some point. And it's still paying me over $1,000 in dividends quarterly, which gets reinvested at a lower price. So I think it's a good deal. Anyway, you can take things out. So that was my first closed-end fund. And I was I always liked that one. Didn't know much about closed-end funds, but I got to know them a little better when all this market gyration started this year. And I've always wanted to own Berkshire Hathaway. I actually own some Berkshire Hathaway. I've gone to the annual meeting. It's a real hoot to go to. This has a fairly big state, and it's this one called BIF. It has a new name. Actually, I think the name's very bad. The name for it now is Screw. Screw you over if you buy Biff. I don't know. I think that's really funny, but this owns a lot of Berkshire Hathaway and a lot of good stocks. And it pays, closed-end funds pay a lot. It only pays quarterly, and a lot of them now that I own are paying monthly. So they just keep going up, and they pay me and they buy more stock when it's down. All right, I can't find it quickly, but it would show you that. I bought an All-Star, Liberty All-Star. Liberty All-Star has a lot of growth stocks in it, but they write options on them, so they still make money. So I'm still closed-end funds do not tend to go down. They pay you monthly or quarterly, and they don't tend to go up and down as much. They don't go up as much either, but they don't go down as much. But they keep growing. It's my source capital. You can see how it grew from 8,000 to, at one point it was worth 107,000. And in the meantime, I've taken out 40,000 from it. So you can see how that grew by just reinvesting the dividends and being patient and never selling it. And BIF does that. It's going up. The interesting thing, how many of you know the difference between the NASDAQ and the S&P 500? Yeah, okay, so the S&P 500 is much more conservative. You expect to make 7 to 10 if you just invest in the index, okay? And NASDAQ has more of the growthy stocks, tends to. I always say you can tell if it's got 3 letters or 4 letters. Not true across the board, but most 3-letter stocks are in the S&P 500, and most of the 4-letter stocks are in the NASDAQ. Well, there's a closed-end fund which I just bought. I'm running my niece's account. I started one for her with her inheritance that I'm giving her. And I bought QQQX. Well, QQQ is the NASDAQ. And I bought QQQX because it I think is paying I don't know what it's paying today, but it's paying when it's gone down, probably between 7 and 11%. And so it's gone down a teeny bit with all this crashing going on, you know, but hardly any. So I actually have a put on that. This is one you can buy by puts and calls. So it went from, I think I bought it for her around 25, which was low at the time I bought it. And it's down now to 23.90, or it was yesterday. And I put a put on it, I think, at 20. So, and I don't think I've sold the put yet. But if the market continues down, I think that put will sell. Would I be happy to buy that, having it pay me all these high dividends? You buy the NASDAQ itself, it doesn't pay that. But you buy the closed-end fund, and it does because of the way they operate it. So I'm much more into looking at the closed-end funds right now, not totally, but you also want them in your IRAs or things, because if you put a lot of them in your main account and the dividends keep going up, that's where I'm really hurt with taxes now. Because when I started out when I was young, it didn't matter, you know, that wasn't going to kick my income up enough because I didn't have enough income. But now, it really kicks my income up, and then I pay 4 times what Trump does for taxes or more. So it's smart to put something like that. If you know you want to buy it's very good. I finally decided that I would never buy anything at a point in time that didn't pay a dividend, because it seems so much more logical to be being paid. You know, you're paid when it goes down, you still get your dividend. And that cushions these downside problems with investing. Anyway, anybody have any questions on closed ends? You can go on Yahoo and look up closed-end funds, and you can read about all kinds of them. And by the way, there are, I think, 13,000 Bitcoins of different kinds now, just for your information, maybe more than that now. My grandson actually made money on Bitcoin. I'm gonna switch over to this just briefly, a little story. He made money on Bitcoin because he was able to become a miner. He bought a really powerful computer, became a miner, and he's 16. And he made a bunch of college money. And then he couldn't do it anymore because actually, if you want to make money in Bitcoin, you're a miner. The miners make the money. The miners never don't make money. But it's a lottery system, and the lottery system has grown so much. I mean, you have to throw in all these numbers, and if you get picked to be a miner, fine. But it's a crazy world, and I have one article here that talks about all the fraud that goes on. One man lost $700,000. There's no way to make it up. He lost his password, he never could find it, he lost $700,000 in Bitcoin. So, anyway, but my grandson now, he can't do it anymore. He doesn't have the equipment, he doesn't have enough, but he hit a little window of time when he did. You know, and that can happen. All right. So closed-end funds, if you want to research. The contrarian, I'm showing you 2 portfolios of closed-end funds that I own. I am going to tell you about this one. This is through contrarian income. They're here. You can take a picture of these, and then you can see how they pay out. You'll see what I'm talking about. That's these 2. Now, they only suck you in if you buy newsletters. They suck you in, and they suck you in with something cheap. Most newsletters I pay like $49, $79 for a year. They're cheap. And then as they go on, I got in the closed-end fund one, I got contrarian income, and it's good. I don't cry. And then they tell you about hidden yields, which cost a little bit more, and it's different. They have stocks that pay a lot, so they're more into stocks that pay a lot. And now, then they have an insider. Now, I've never purchased the insider, but that's the top of the line. But of course, they don't tell you about that until you've already gotten the other 2, in hopes that then, in fact, you will buy 3. So, I'm telling you that's how they work. So if you look at any company that is selling a newsletter that you might be interested in, you should take a good look and ask them what vehicles they have, all of the possible vehicles they have and how much they are. And not just buy the first one and then find out about the second one. Kathy?
We have about 5 minutes.
Okay, all right. So I think the only other thing I'm going to talk about a little bit is MLPs. MLPs are largely energy stocks. They pay you an awful lot, but they are a nightmare at tax time. You have a tax form. My accountant just wants me to get out of any MLPs I have, but they can pay a lot if you know a lot about doing your own taxes. I have had MLPs before, and an MLP is a master limited partnership, okay? And they pay you up to 90% of what they get. They have to by law. It's like REITs. MLPs are like REITs.
Where is it on there?
It's on page 3 under stocks. Where did I just see it? MLP, oh, I have it written on mine. I have it actually at the end of closed-end funds. It's on mine. I may not have it. I don't think I have it on here. MLPs are master limited partnerships, and they are, they can pay you a lot. They're a nightmare at tax time. They're a little trickier. You want to research them, that you can get paid a lot from them. And they are worth looking at. And some in the energy space are paying a lot of money now. So it's just, you know, if you always do your own taxes, I would be wary of getting into MLPs. And you can buy funds of MLPs where then you don't have to buy the MLP and get into that tax lot, but I haven't done that. But they are something that pays a lot, and they're paying a lot right now. Several companies are. And in the closed-end funds, they will tell you about some MLPs that are paying a lot. So I get that information from that particular, those newsletters I take, okay? Anyway, that's mostly what I wanted to say. And oh, I just said, okay, getting on to my very last page, you do want to be diversified. Large cap, medium cap, small cap, US, foreign, global, that's a little paragraph on here, it's worth looking at. Be careful, don't ever buy a penny stock. I made that mistake once. It's boilerplate. Somebody calls you and they want you to buy this stock. And I did that once. I mean, you learn as you go along. And I had that learning experience along with my one on Washington Mutual, which was definitely the most painful I've ever had. And, but you just don't buy them because somebody will hype them up. You buy in, then they get enough people to buy in to just hype up theirs, and then they all sell out, and you're left holding something that's worth $1 or nothing. So you don't ever get caught up on a penny stock. So I just said investing is very humbling. You will win, you will lose. The object is to win more than you lose. I lose on some of my options. I have to buy them back. I have one I'm going to buy back that I have to pay more money than I made on the option. I do that. But my options up on all my accounts are up like 30%, 34%. Because you make money while the market's going down. And it's one really good way to make money while the market is going down. Inheritance for vehicles. Make sure you do transfer on death. This is really important to have TODs set up for your accounts. Transfer on death. My IRAs, my main things will go right to somebody. They don't go through probate. They don't go through anything. So I have very little that would go through probate because I've done transfer on death. And you can do that with all your IRAs and all your annuity type things. So I think that's an important one to know. I was going to tell you just a few. I go through TD Ameritrade, who's been bought out by Charles Schwab. That's who I do all my brokering with. Interactive Brokers is the cheapest per service, but I can get more help from TD Ameritrade and Charles Schwab. Fidelity is good. Annuities, I've got some you can see over here. Alliance Annuity, materials from David Donhoff, leverage planners. I mean, usually I give about a 2 or 3 hour thing, and a lot of this gets explained more. So, the only other thing is if you ever use an advisor, make sure you get one who is considered a fiduciary. Write that word down, that's so important. Don't ever work with anybody who is not a fiduciary. And then find out what kind of degrees they have, like a CPF, Certified Financial Planner. A fiduciary has to put you first. You know, I go into Chase and they want to sell me something because Chase is selling something. You know, it's some stock that the bank has glommed onto that they want to sell to everybody. I just don't touch that with a 10-foot pole. But a fiduciary has to look at you, and if they don't, then you can sue them. My daughter has 2 master's degrees in opera performance. She also has a certified financial planning certificate, so she knows what she's doing.
We should wrap it up. Maybe take questions.
So I think the other thing is I'm going to just leave some of this out if you want to take pictures of some of it. It would be worth it to look at, especially these 2 portfolios I brought you. These are current for the closed-end funds. I think you would find those interesting. And again, closed-end funds are a part of what you want to do, only a part. But I have found that I've made a lot more money investing in individual stocks than I ever came close to making in mutual funds. And my husband went under. He always did mutual funds. He went under. So I am our sole means of support. I paid his $400,000 debt out, and I'm our sole means of support till we die. And I could lose 50% of what I have right now and be fine. So, and later on, I could live on my dividends. If I just decided to not have my dividends reinvest, I could live on them for the rest of my life, which may or may not be very long. I almost died in the hospital 2 weeks ago. I had 2 surgeries in a row. You know, when they bring in the priest that says, do you want, and by the way, do you want us to keep you alive or do you want us to let you go? It was a little more serious than I planned on. Okay. But, so questions, and then I'd like you to just photo anything that you want that's up here. All right? So
You're amazing.